Have you ever sold something just to feel less helpless? It didn't feel like panic at the time. It felt like responsibility, a sensible, grown-up person taking charge while the screen turned red. And then, quietly, the market climbed back, without you, and you never quite mentioned it to anyone. Tonight, I want to answer the one honest question that sits underneath all of that low background guilt. Is doing nothing actually a strategy? Or is it just neglect wearing patience as a disguise? Over the next few chapters, we'll look at what the evidence really says about touching your portfolio, why the calmest investors act so rarely, what a lifetime of small adjustments quietly costs, where sitting still genuinely fails, and how to guard against it, and how to turn do nothing from a failure of nerve into something you do on purpose. By the end, you'll be able to sit through a red morning with your hands in your lap and know, without needing to check, that the stillness is the move. Chapter 1. The Gardener Who Kept Digging. Picture two people who plant the same seeds on the same morning in the same soil. One of them can't bear the waiting. Every day she kneels down and gently lifts each seedling out of the ground to check the roots. Are they growing? Are they doing their job? Then presses the soil back and stands up reassured. The other simply waters and walks away.
You already know whose garden survives. The roots that are left alone are the ones that take hold. The ones inspected every day never get the chance to grip anything at all. A portfolio can die that same quiet death, not from a bad market, from being handled. Every check, every nudge, every small just-in-case adjustment is another seedling pulled up to look at the roots. It feels like care. It's usually interference. And the cruelty of it is that the interference never announces itself as harm. It always arrives dressed as diligence, as the responsible thing, as exactly what a careful person ought to be doing. More than 3 centuries ago, Blaise Pascal wrote that all of humanity's troubles come from a single source, our inability to sit quietly in a room, alone. He wasn't talking about money, but he might as well have been. Behavioral scientists have a plainer name for the same instinct now. They call it action bias. It's the deep old preference to do something, anything, rather than wait, even in the moments when waiting is the winning move. Think of the goalkeeper facing a penalty. The statistics quietly favor standing near the middle of the goal, yet almost every keeper hurls himself dramatically to one side because standing still, even when it saves more shots, feels unbearably like doing nothing while the ball flies past.
We are all that goalkeeper at 6 in the morning, thumb over the button, unable to believe that stillness could be the skilled response. So let me offer you a small reframe to carry through the rest of this. Not selling is not the absence of a decision. It is a decision, often the hardest one you'll make all year, and often the best. The person who closes the app and does nothing has, in that moment, done something quietly difficult on purpose. But it feels better is not the same as it costs nothing. Every time those restless hands reach in, there is a bill, and it is larger and stranger than most people ever imagine. So let's do the thing action bias never lets us do. Let's slow down and add it up. Chapter 2. The Cost of Restless Hands. 2 finance professors, Brad Barber and Terence O'Dean, published a study in the year 2000 with a title that leaves little room for argument. Trading is hazardous to your wealth. They followed more than 66,000 households at a discount brokerage across the first half of the 1990s. Real people, real accounts, real decisions made at kitchen tables. The market itself returned about 17.9% a year over that stretch. The average household earned 16.4%.
But the households that traded the most, the busiest, the most engaged, the ones who surely felt the most in control of their own money, earned just 11.4%. The more they touched, the less they kept. Not a little less, a third of the market's return handed away in exchange for the feeling of being on top of things. Here is one figure worth setting down slowly, like something fragile you don't want to drop. J.P. Morgan Asset Management ran the numbers on the 20 years from 2003 through 2022. $10,000, left fully invested in a broad U.S. index and simply never touched, grew to roughly $64,800, a little under 10% a year.
Now take that same 20 years, that same 10,000, and remove just 10 days. Not 10 years, 10 days, out of roughly 5,000 trading days, the 10 best ones. Your 64,000 collapses to about 29,700, less than half of what patience would have given you. You didn't do anything reckless in that second version. You didn't gamble or chase or overreach. You simply weren't in the room on 10 particular mornings. And here is the part that should quietly change how you see every crash from now on. 7 of those 10 best days landed within about 2 weeks of the 10 worst days. The great up days and the terrifying down days are neighbors.
They live on the same street, sometimes right next door. The rebound doesn't wait a polite month for your nerves to settle and your confidence to return. It often comes screaming up out of the very same fortnight that frightened you into selling, which means the investor who sells to escape the worst days is almost guaranteed to be standing outside on the pavement, keys in hand, when the best ones arrive. The exit and the recovery use the same door, and they use it within days of each other. Morningstar keeps a long-running study with a gentle name, Mind to Tap. Over the decade ending in 2022, it found that the typical fund investor earned roughly 1.7 percentage points less each year than the very funds they owned. Read that carefully because it's an unusual sentence. Same funds, worse returns. The gap wasn't the market's doing, and it wasn't the fund managers. It was the timing of the investor's own hands. Money poured in after prices had already risen. Money yanked out after they'd already fallen. Enthusiasm bought high, fear sold low, over and over, and the difference leaked away one well-intentioned decision at a time. That gap isn't the market's fault. It's the fee we charge ourselves for the comfort of doing something. This is the one place that worn old phrase earns its keep. Time in the market really does beat timing the market.
So treat every trade you're tempted to make as guilty until proven innocent. Assume it will cost you something, in tax, in spread, in the near impossibility of buying back in at a better moment, and make the urge carry the burden of proof before it's ever allowed to move your hand. Which raises a fair objection. If sitting still is so obviously wise, why is it so hard? And is there any way to make it feel less like a nightly test of willpower? There is, and it has almost nothing to do with willpower. Chapter 3. Stillness is something you build. The calm investor is not calm by temperament. That's the quiet secret of it. They didn't inherit steadier nerves than you, and they don't feel the red mornings any less. They built a portfolio that no longer needs their nerves. Think of it the way you'd think of a thermostat. You don't get a comfortable house by standing at the dial all day, nudging it up as a cloud passes and back down when the sun returns. You choose a sensible setting once, and you let the system hold it. A durable portfolio works the same way. You decide your mix of stocks and bonds, you spread your money widely rather than betting it on a favorite, you automate the monthly contribution so it happens whether you're paying attention or not.
And perhaps you rebalance on a fixed calendar, say once a year, or whenever your mix drifts past a set band, so that even your adjustments are decided in advance, by rule, not by mood. Say you set a 5-point band on a 60-40 mix. You only lift a finger when stocks slip under 55% of the portfolio or climb past 65, which most years means you do nothing at all. The rule handles the rare exception, so your feelings never have to. And then your default state becomes stillness. Not because you're ignoring the money, but because you built something that doesn't need rescuing every time the news gets loud. The structure does the worrying, so you don't have to. Charlie Munger, Warren Buffett's lake partner, put the temperament in a single line. The big money, he said, is not in the buying and selling, but in the waiting. Notice what that means. The waiting is where the compounding quietly happens. It only looks like nothing from the outside. So front-load your effort. Pour your energy into a handful of good structural decisions, made carefully, once. Then let do nothing become the thing you engineered on purpose, rather than a battle you have to win again at 2 in the morning, alone, with your thumb over a button. Now, I've spent 3 chapters praising stillness, and if I stopped here, I'd be selling you something too clean to be true.
So let me turn and argue against myself as honestly can. Because just hold and wait is not magic. History has punished people who trusted it blindly, and you deserve to hear the strongest version of that before you build your whole temperament on it. Chapter 4. When standing still isn't enough. The hardest case against everything I've told you is Japan. On the 29th of December 1989, the Nikkei 225, the main index of Japanese stocks, closed at 38,915, a record. The mood in Tokyo at the time was that the rise would simply continue. Japanese assets were the envy of the world. An investor who bought that day and did the very thing I've been praising, held on, faithfully, patiently, waited to see that level again until February of 2024. 34 years. Most of a working life spent loyal and calm, and still, for decade after decade, underwater. If you ever meet someone who thinks patience is a guarantee, that number is the answer. It should frighten you a little. It's meant to. America has its own scar. The years 2000 through 2009 are remembered as the lost decade, 10 full calendar years across which the S&P 500 delivered a slightly negative total return. A decade of loyalty that paid, on paper, less than nothing. And zoom all the way in down to single companies, and it grows sharper still.
General Electric was once the most valuable company in America, a name that seemed as permanent as the country itself. It peaked around the year 2000, never saw that height again, and was quietly removed from the Dow in 2018 after more than a century inside it. Citigroup came out of the 2008 crisis so diminished that it did a 1-for-10 reverse split, folding 10 old shares into one just to keep the share price respectable, and has never come near its former peak. Doing nothing with a single stock can mean holding a falling knife all the way down to the floor and calling it discipline the whole way. So sit with that fear honestly for a moment, because it's real, and no amount of soothing language should be allowed to wave it away. And then look closely at what actually broke in each of those stories, because it's the same thing every time, only wearing different clothes. Concentration. One country, one decade, one company. In every case, the thing that failed wasn't patience. It was betting the patience on something too narrow to deserve it. And that tells you exactly what makes Stillness safe. The patient investor's protections are specific, and there are 4 of them. First, global diversification, so that no single country's lost 30 years can sink you. Japan was a catastrophe on its own, and merely a footnote inside a portfolio spread across the whole world.
Second, a broad index instead of a beloved single stock, so that no one company's collapse is ever fatal. The index quietly drops its failures and adds tomorrow's winners without asking you to make the call. Third, a time horizon long enough that any one crash becomes a chapter rather than the ending. And fourth, as you approach the years you'll actually spend the money, some bonds and cash, so that a bad early stretch doesn't force you to sell your stocks at the bottom to pay for groceries. That last one has a name most beginners never hear, and it deserves saying plainly: sequence of returns risk. 2 people can retire with the same average return over 20 years and end up in completely different places, purely because of the order in which those returns arrived. A poor run of markets in the first years of retirement, combined with the withdrawals you're now making to live on, can do permanent damage. You're selling shares to eat right when they're cheapest, locking the losses in. A younger investor with a paycheck and no need to sell would simply have waited that same storm out. Same market, opposite outcome, and the only difference is timing and whether you were forced to act. So here is the honest boundary. Do nothing is powerful advice bolted to a broad, diversified portfolio. Bolted to a single lottery ticket, it's just hope with better posture.
Earn the right to sit still by first making sure the thing you're sitting on is spread wide, across companies, across countries, across time. And once it is, once you've genuinely earned that stillness, something becomes available to you that most of the professional world, for all its brilliance and all its resources, simply cannot buy. Chapter 5. The Quiet Advantage. There's a story that drifts around the investing world. A large fund company, so it goes, once studied its very best performing accounts to learn what those investors had in common, and found that many of them belonged to people who had forgotten they owned the account at all. Some had died. Others had simply lost track of it. The firm has never officially confirmed the tale, so hold it as a parable rather than a fact. But whether or not it literally happened, it captures the thing every number in this piece keeps pointing at. What protected those accounts wasn't genius, or timing, or a clever read on the economy. It was absence. Nobody was there to interfere, so nothing interfered. Now think about the professional fund manager. He has to justify a move every quarter. He is measured on activity, watched by clients who will leave if he says plainly and correctly, "I did nothing this quarter, and it was the right call." Being still, for him, looks like negligence. It gets him fired.
So he trades not always because the portfolio needs it, but because he needs to be seen earning his fee. His restlessness isn't a character flaw. It's built into his job. Now think about you. No board, no quarterly report, no clients. No one at all demanding you look busy with your own money. That freedom to be still is not a small thing. It is a genuine structural edge, and it was handed to you for free, precisely because you're an amateur rather than in spite of it. The market, in a line often laid at Buffett's feet, is a device for transferring money from the impatient to the patient. And you get to decide, quietly, every single morning, which side of that transfer you'd like to be on. So start keeping a different scoreboard. Alongside the trades you made, begin counting the ones you didn't. The red morning you wrote out, the tip you let pass, the app you closed without touching. Those unbought trades are the real wins of the year. They just never announce themselves. So let's go back to where we started. 6 o'clock, the screen already red, your thumb resting over the button, and that small, insistent voice telling you a responsible person would do something right now. You can see that morning differently now. The person who closes the app and pours the coffee isn't being careless or lazy or asleep at the wheel.
They're doing the quiet, deliberate, genuinely difficult work of letting a good decision keep working, a portfolio spread wide enough and a horizon long enough that the storm on the screen is a chapter and not the end. Some of the strongest things you will ever do for the person you'll be in 30 years are going to look from the outside like nothing at all. Not selling, not checking, not flinching. That was the whole question we set out to answer, whether doing nothing was neglect dressed up as patience. It isn't. Done on purpose, on top of something built wide and left alone, it is the strategy. If this brought your shoulders down even a little, subscribing is the quietest way to keep evenings like this coming. And I'd genuinely like to know which idea stayed with you, the gardener who kept digging, the true cost of restless hands, or the quiet advantage of being free to wait. Leave a comment and tell me. We'll be here, in no hurry at all.